put your money to that country which is giving you higher interest rate, and you let it open for exchange rate risk exposure. So this is how you basically say fancy international finance jargons or terminologies. In real sense, what are you doing? You're just investing in that country who is giving you higher interest rate, and you let yourself exposed to exchange rate risk. You don't cover your position. You don't buy the forward interest rate. Then we call this uncovered interest arbitrage. Covered interest arbitrage, in which you invest in higher interest rate countries and at the same time purchase the forward rate agreement or forward agreement. That's it. So let's watch this.
Covered interest arbitrage is a trading strategy that investors use to try to profit from the differences in two countries' interest rates. For example, the interest rate in the Eurozone might be 15% per year, while the interest rate in the United States is 5% per year. Unfortunately, unfavorable exchange rates could eliminate investor profits. To avoid this scenario, covered interest arbitrageurs use a forward currency contract so that they know what exchange rate they will receive when they convert their investment back into their original currency. Investors need to know two things: the exchange rate when they initiate the trade. For example, €1 equals $1.39, the spot rate. And they also need to know that they can later convert euros back to dollars at a rate of €1 equals $1.35, the forward rate. For the trade to be profitable, this hedge must cost less than what the investor will earn from investing in the currency with the higher interest rate. Angela has $1 million to invest. If she invests at home, she will earn 5%, bringing her total to $1,050,000. But what if she uses covered interest arbitrage instead? First, she converts $1 million to euros to get 721,500 euros. This investment earns 15%, bringing her new total to 829,725 euros. She then converts her investment back into dollars, receiving $1,120,129. Opportunities to profit from covered interest arbitrage are rare, especially in highly active markets where all market participants are equally informed. Also, the market usually brings any imbalances back to equilibrium when investors who identify such an opportunity place a flurry of trades in an attempt to make a quick, riskless profit. Their profits are typically small, and taxes and transaction costs can eliminate gains from covered interest arbitrage.
I hope this clarified your further confusion that how we are going to do that. So, like I told you, after sometimes, or after a matter of seconds or matter of minutes, the market realigned itself and corrected the balance of exchange rates. So now we know that, if we further want to explain this, that is, we know that forward is equal to spot rate into 1 plus forward premium. So if we want to find out what is the value of premium, so premium, if we just rearrange this equation, it will be like this, right? Or forward divided by spot rate minus 1, if we further simplify this, right? So we have an example here which we already did that in our last or previous lectures. So if the euro spot rate is 1.40, 1 year's forward rate has a 1 year forward. One year forward rate has a forward premium of 2%, and 1 year forward is equal to forward into spot into 1 plus 0.02, right? Premium. So if you want to find out the premium, you can rearrange the formula. You can find out the formula as well, premium as well. So now let's talk about the interest rate parity. So we just talked about that, okay, If any country is giving you higher interest rate, so everybody's rushed towards that country and invest in that country, right? If that's happening and that is giving you higher, higher value, then why it is not working in real life? In Pakistan, the interest rate is 14%. In United States, it is 3 to 4%. In Japan, it is close to 1 or 2%. Why then Japanese are not investing highly in United States or in Pakistan? The difference is because of interest rate parity. And what does it mean? It says that the forward rate differs from the spot rate by sufficient amount to offset interest rate differential between these two countries. Amazing. So what does it mean? It means the country who is giving you highest interest rate, its forward premium will go up. So when you start converting back your interest and principal to your home currency, the forward rate already will be bigger and you won't be benefited from this trade. Right? So in that scenario, what this interest rate parity says, it says premium is equal to, which we just calculated from previous slide, that is premium is equal to forward minus spot divided by spot, right? So they say that it is also equal to 1 plus home country's interest rate divided by 1 plus foreign country's interest rate minus 1. Or if we say the estimation, it is equal to, it is the difference forward in roughly sense, the forward premium is equal to interest in home country minus interest in foreign country. So look at that. If home country's interest rate is higher, what does it mean? It means for a foreign interest rate, the forward premium will go up. We will be receiving the forward contract at higher forward rate. What if the foreign country's interest rate is higher? Then what does it mean? It means our currency is going to be traded on forward premium or forward depreciation, or premium will be negative. It means currency will depreciate. So negative, if this value is higher, then of course we will be having a negative premium, which means our currency is going to be depreciating as well. Okay, this is what we were telling about that. So the relationship between forward premium and the interest rate differential according to the IRP, interest rate parity, the forward premium would be the difference of home interest rate minus the foreign country's interest rate. So remember, this is estimation. If you want to find the exact value, so exact value can be calculated as 1 plus home country's interest rate divided by 1 plus foreign country interest rate minus 1. Right? So this is just the approximation. If question is giving you, you need to calculate the exact amount, so that would be done through 1 plus home country interest rate divided by 1 plus foreign country interest rate minus 1. Right? This formula. Okay, so more on interest rate parity. Interest rate parity does not imply that investors from different countries will earn the same return. That we just find out that whether I invest in my country, whether I invest in other country, I would be receiving the same amount, because the forward premium gonna be adjusted. But in reality, it doesn't happen. Why? Because of limitation to the data plus We will be talking, seeing that in coming slides. That plus the transaction cost, plus the taxes. Maybe the tax system on the interest rate is different between these two countries, right? It's because of that. So let's just talk about the interest rate parity. We have a very nice example here. I hope it further clarifies your any ambiguity or any confusion. Let's see that.
Uncovered interest rate parity is the condition in which the difference in interest rates between two nations is equal to the expected change in exchange rates between those nations' currencies. For example, an investor in the United States has two options. She can spend $1,000 buying a US bond with a 10% interest rate. After a year, she'd have $1,100. Or she could invest in a Canadian bond, which has a 15% interest rate. She figures her return as $1,150, multiplied by the exchange rate between the US and Canadian dollars. If there's uncovered interest rate parity between the two investments, the Canadian dollar will depreciate against the US dollar by about 5%. In other words, the expected change in the interest rate will be equal to the gap between the two interest rates. To convince an investor to invest in the Canadian bond when the nation's currency is expected to depreciate, the Canadian dollar's interest rate would have to be about 5% higher than the US dollar's interest rate. An arbitrage opportunity, the chance to buy one investment and simultaneously sell it in another market for profit, exists in the absence of uncovered interest rate parity.
So now you understand why we talked about the uncovered interest rate. What do we mean by uncovered here? Because we do not enter into any forward contract, right? So interest rate parity holds, and what it says, if we are not doing any other stuff and we are not covering our position, then what happens? We will be better off to invest in our home country. Why? Because if the other country is giving us higher interest rate, the forward premium also going up. So which will be eliminating our position, eliminating our entering into a biggest profit or capitalization or a high profits, right? Let's move forward. So when you want to invest in other countries' interest rate, you need to exploit the interest rate. So remember transaction cost as well, plus political risk, because you will be investing or you will be placing your money for a year or for 6 months, right? Because interest is going to be paid after the time pass, right? So during this period, you need to predict the political instability as well. If anything, unstable, if there is political instability over there, then exchange rate, goes up or goes down drastically, eliminating your even principal amount, right? This poses a huge risk. The third one is differential tax laws. Not every country is, deducting 10% tax rate on your interest rate. Some countries even deduct 40%, 30%. So you need to be very aware regarding the tax laws over there, that how my return is going to be taxed in that country, and what happen if I receive the money here in my home country, what will be the tax treatment of my own country as well, whether we have this kind of a law of singularity or not, whether I will be double taxed, right? So you need to see that. So that's why international parity doesn't hold sometimes, or because of data is not available, or because of transaction cost, or because of the political risk or different tax laws, right? So now we will be jumping in on the chapter 8, and we will be talking about purchasing power parity, international Fisher effect, and